Welcome to readtheticker.com. The chart you see in front of you is XOM Mobile, symbol XOM. Now, the uneducated and probably the retail investor would do a sort of study like this. They would probably get the picture that the XLE or the spider sector XLE is doing well, bit of a sector leader. They might even do a bit of a fundamental study and sort of realise that the tensions in the Middle East are forcing up oil prices, thus the energy stocks, especially the leaders, should do okay. Basic fundamental stuff like that. And then they might go to the chart and say, okay, what have we got here? We've got a resistance, support there, resistance there, and they might even do a bit of an Elliott wave count. They might go A, B, C, or 1, 2, 3, and try and work out whether it's a good time to buy here. Now, I personally think that's not enough detail to understand how the institutions are thinking. And the only real way to understand how the institutions are thinking is to understand Wyckoff logic and how he describes the reaccumulation process. Reaccumulation is when you've got an uptrend, there's a pause, and then the uptrend continues. It's like a continuation phase, but on a large scale. Here's something that sort of forgotten at the retail investor level. As a retail investor, he might have 10 grand, 50 grand, 100 grand, 500 grand, 10 million. He'll go to the market in one day and put an order in to buy 20, 30, 50,000 shares of a stock, and it'll probably be filled within minutes. The institutional investor can't or doesn't do that. They might be buying 50 million shares or 10 million shares or whatever the sum may be, but it might take 3 to 4 weeks to get his position filled. So they have to have a strategy. They have to have a campaign to accumulate stock float. Because quite frankly, there might be 30 institutions that own ExxonMobil and not one of them want to sell. And the only floating stock float out there might only be 1 million shares. I'm just making these numbers up. And somebody wants to buy 5 million. So that means they've got 1 million shares on float traded daily by the retail market. And there's another 4 million they want to acquire, but nobody's selling of the holders within the ExxonMobil share registry. So they have to create a means to shake them out of their positions. So there's a campaign that goes on, the process to determine whether the weak hands will release their stock float to other hands. It's just a transferring of wealth between players in the market. And there's a process they do. It's the shake up and the shake down of business in the stock market. But there's definitely a campaign approach. News is used to shake the weak hands so the strong hands can acquire the stock float for profit. Now, a famous quote by Jesse Livermore, when Richard Wyckoff was doing an interview with him, the large operator, aka the composite man, does not, as a rule, go into a campaign unless he forecasts a movement of 10 to 50%. Livermore once told me he never touched anything unless there was at least 10% gains in it, according to his calculations. The point here, the composite man, that is the large informed operators. That's the people who have the millions of dollars to do research. These are the people who have allocated individuals who interrogate everything and anything about a stock and the directors and everything about a particular company. They leave a footprint when they conduct a campaign of an accumulation. A footprint in the market which can be analysed and followed to see how the accumulation is going. And if you understand this, what we call Wyckoff logic, because Richard Wyckoff was the first one who put this to print and actually taught it as a market approach, then you have an idea how the campaign is going. And what's more importantly, if there is a campaign and you can see it happening, you know prices are going to go higher because once they've accumulated their float, they're going to mark it up because they've accumulated their float, they want a profit, so prices are going to go higher so they can sell it at a higher price. So therefore, it's very beneficial to see the footprints of the campaign of the composite man to see a chance to profit. Okay, so here, to study the Wyckoff logic, we go to well-known written rules about the subject. Here we have a accumulation pattern here. This is an accumulation at the bottom. What we're actually looking at reaccumulation, so therefore we swap phase A for distribution for the phase A of accumulation. So we're looking at phase A of distribution that goes into phase B of accumulation. It's a bit like this pattern down here, reaccumulation. We've got an upswing instead of a downswing going into the accumulation pattern. But pretty much the footprints are the same for B and C and D in the accumulation phase. And in the end, we want to see a footprint of a staircase climbing the price. But we have to understand that there's a campaign at each support and resistance level, and it's good to see the footprints. Here's a high-level study of what could go on in the trading range. So let's have a look at XOM Mobile. As I showed you in the diagram, there's phases A, B, C, D, E, and I'm just going to explain those. Let's activate. Okay, so here, if we were studying the campaign of ExxonMobil through September 2012 and November 2013, we would see we had a strong up move. Let's read a bit larger. By the way, we just have two volume indicators here. RTT-OBV, which is a weekly setup. It's a volume oscillator. We have a weekly trend power OBV here. It's also a volume tool. What we want to see, phase A is defined by a strong move up on the reaccumulation with a some sort of climax and an automatic move down. So whenever you have an up move of strength, you're going to get profit taking the end of it. Now in reaccumulation, the buying climax, the high volume is not as important because that's more relative to a top. So this is a reaccumulation and not a distribution pattern. So what we normally see in phase A and reaccumulation is a strong step into it and then an automatic move down. So that really signs off phase A and also helps set up the range, the highest point of phase A and the lowest point of the automatic move gives us our trading range. Now phase B, well phase A is the profit taking, and some people would give up their float at that position. They'll take their profits and run. They wouldn't be strong enough to hold it through because they don't know what's coming. They don't believe in the long term. So there's a bit of a shakeout here for those people who are weak holders of the long term trade. Phase B is the situation where everyone's waiting for a rally. There's a couple of false starts. This is the tire out phase. So this is where people are really trying to do all sorts of tricks to get the float of other institutional investors and the retail trader. Here phase C is a testing phase, and this particular case is actually quite interesting because we had to test the upside that failed here, and then we go back down to the support and we have a final test down here. So normally in the phase C, it is a process of testing. You'll either get a breakout here or price will swing down here and get a test of support. It might even break it, take out stops, and then go on up. The phase C is known as a testing phase, and we can confirm phase C was testing. So here, more weekends would have been shaken out here, of course. Now phase D is the sign of strength phase. As you can see here, it shot up very strongly with pretty good volume. Volume indicators all show good stuff. And phase E is when it starts moving away from previous resistance that comes to our support. Now in this particular case, we had a breakout, we had a test, but the test is quite deep. It actually fell back into the cause, so this is what we call a cause, just between there and there. But this horizontal range is the cause or the reaccumulation. A cause will always end up with an effect. The more a cause represents a determined campaign, the more likely the effect will be handsome and rewarding. So here we call that a cause. And one of my personal identifications is when you get a breakout here like we saw in phase D, and it actually sinks back into the cause. That's actually a challenge of the cause, because really the ideal situation, it actually falls back and holds on support, which is previous resistance. But when it falls back into it, it's actually a challenge of the whole campaign method. So the bulls who have been accumulating this better step up here in the middle of the cause to prove that the trend is still on. So here we had all this accumulation, reaccumulation going in here, a break up on strength, and then it fell back hard into the cause zone. So that's a real test of the bulls. Are you going to stick with the campaign, or are you going to give up? So here they said, yes, we're sticking with it. That's a very powerful buy. It's like a power buy. Normally and hopefully that it would only bounce about that level there and hold on. But the fact that it went deep into the cause and bounced up was, quite frankly, a really determined effort by the bulls. So what happens here, it starts moving away, and we're beginning to see our markup process. And what I have here is I have the range here. Our equal move up is to $100. 2 equal moves up is just 112. So that's those are the targets. As you can see, we've gone to the first target. There's actually something else going on here which is quite interesting. So once again, as I just said before, we've got a strong move up, an automatic move down. So what happens when we put study two campaigns? Just reactivate the second one. As you can see here, just like the first move, we had a strong move up. We had an automatic move down. So yes, I'm just redefining this to show the step process. Strong move up. Whenever you get a strong move up, someone's going to come into profit taking saying, yeah, I've accumulated here, I've made my $5 and I'm selling. They're just not strong enough to hold into the long trend and don't make the big money. So we have a bit of a phase A again repeats, phase B. But in this particular case, because it's markup process, the test comes early. And what you see here, as you compared to this process here, is that the test at resistance is quite solid. Selling did come in. These first 2 weeks here are selling. The point here, selling was absorbed. So all the people who gave up here, couldn't hang the trend, other folks brought up and said, yes, I like this. So any selling here is absorbed, and that's very bullish. So once again, the automatic move on this trading range is to $115 in one step. That equals 2 up here. So as you can see, targeting 115 is looking pretty confident right now. And if we want to throw in as I previously discussed before, our golden ratio, we can take the two ranges here. And as you can see, the first 38 percentile is actually the consolidation phase. This is the decision time, whether it goes higher. Target 110, or we take the larger range between the lower campaign to the higher campaign here. As you can see, the target's really, quite frankly, 130. So, which is pretty much if crude oil gets above 120, 130, you're really getting into serious trouble at the gas pump, and obviously recession will be a real contender around the world because the oil. The cost of oil and diesel and gases and everything, and if the energy sector is going to get that red hot, it'll be quite concerning. So what we've done here, we've analysed the campaign phase by the composite man in detail to see what's underneath the hood, to understand how the institutions are trying to get stock float from weak hands to get price up. And if you know the steps and understand the phases, you can determine whether a cause is likely to have a very, very rewarding effect. In the end, you end up with something like this, which might seem pretty obvious to the retail investor, but the professional understands what's going underneath the hood. Those folks who are on the front line at the trading desks, who are working for BlackRock and Warren Buffett and all these other large money accounts, they're accumulating and they're competing against each other to get stock float. Wyckoff logic is about understanding the campaign and the exercising of the trading pattern within the stock to benefit, to profit. Hope you enjoyed this. Thanks for watching.